Something extraordinary just happened in the gold market. And if you're not paying attention, you're about to miss one of the most significant wealth preservation signals we've seen in years. Gold just surged past $3,000 an ounce. Not gradually, not over months. In a matter of weeks, we watched the ultimate safe haven asset respond to something that most investors are completely ignoring. The war drums are beating louder than they have in decades, and gold is screaming a message that every person with savings needs to understand right now. Let me show you exactly what's happening, why it matters more than any headline you'll read today, and what you need to do about it before this window closes. Here's what nobody's talking about. While the financial media focuses on stock market rallies and cryptocurrency speculation, institutional money has been quietly flooding into gold at a pace we haven't witnessed since the financial crisis. But this time, it's different. This isn't retail investors panicking. This isn't gold bugs celebrating. This is central banks, sovereign wealth funds, and the smartest money on the planet positioning themselves for something they see coming. The numbers tell a story that should terrify anyone holding significant wealth in paper assets. Central banks added over 1,000 tons of gold to their reserves in recent quarters. That's not normal accumulation. That's preparation. When the institutions that literally print money are converting that money into physical gold at record rates, they're sending a signal. They know something. And they're acting on it while the general public remains completely unaware. Look at what's happening geopolitically. We're not talking about isolated conflicts anymore. We're watching the global order that's existed since World War II systematically unravel. The BRICS nations aren't just talking about alternatives to the dollar anymore. They're building them. They're settling trade in their own currencies. They're accumulating gold as the foundation for a new monetary system. And every single move they make weakens the dollar's position as the world's reserve currency. Think about what that means. For 70 years, the dollar's reserve status has allowed the United States to print unlimited amounts of currency without immediate consequences. That privilege is ending. And when it does, every dollar-denominated asset becomes vulnerable. Your savings account, your bonds, your retirement funds. Everything priced in dollars faces a reckoning that most people can't even imagine. Gold knows this. Gold always knows first. That's why it's been climbing relentlessly while most investors chase the latest tech stock or meme coin. Gold doesn't care about earnings reports or social media hype. Gold responds to one thing: the destruction of purchasing power. And right now, gold is telling us that purchasing power destruction is accelerating. Let me take you back to a moment in history that mirrors what we're seeing today. 1971. President Nixon closes the gold window, ending the dollar's convertibility to gold. Most Americans didn't understand what happened. They went about their lives, trusting that their dollars would maintain value. Over the next 9 years, gold went from $35 an ounce to $850 an ounce, a 2,400% increase. The people who understood what was happening and positioned themselves accordingly preserved their wealth. Everyone else watched their purchasing power evaporate through inflation that the government insisted was temporary. We're in a similar moment right now. The difference is this time the stakes are higher. The debt levels are astronomical. The geopolitical tensions are more severe, and the alternatives to the dollar are more developed than they've ever been. When this unravels, it won't be a slow decline. It'll be a rapid repricing of everything. Here's what the technical picture is showing us. Gold broke through every major resistance level that traders were watching. The $2,800 level that was supposed to be significant resistance, gold blew through it like it wasn't there. The $3,000 psychological barrier? Same thing. When an asset breaks through resistance levels this decisively, it's telling you that the underlying demand is overwhelming. This isn't technical trading. This is fundamental repositioning. And look at who's buying. It's not just central banks. Institutional investors are allocating to gold at levels we haven't seen in over a decade. These are pension funds, endowments, family offices managing generational wealth. They're not speculating. They're protecting. They understand that when geopolitical risk rises, when currency debasement accelerates, when the global monetary system shows cracks, Gold is the only asset with 5,000 years of history as a store of value. The supply and demand dynamics are absolutely critical to understand right now. Gold production has been essentially flat for years. The easy gold has been mined. New discoveries are rare. Production costs are rising. Meanwhile, demand from every sector is increasing. Industrial demand for electronics and technology. Jewelry demand from growing middle classes in Asia. Investment demand from institutions and individuals who see what's coming. And central bank demand that's breaking records. When you have flat supply and surging demand, there's only one direction for price to go. But here's what makes this different from a typical supply squeeze. Gold isn't just a commodity, it's money. It's the only form of money that can't be printed, debased, or created out of thin air. And in a world where every major currency is being printed into oblivion, that matters more than ever. Let me tell you about something most people don't understand about the gold market. The paper gold market dwarfs the physical gold market by a ratio of over 100 to 1. That means for every ounce of physical gold that actually exists, there are over 100 ounces of paper claims on gold trading in futures markets and ETFs. This works fine as long as everyone's content to trade paper. But the moment people start demanding physical delivery, the entire structure collapses. We're starting to see the early signs of that stress. Premiums for physical gold over paper gold are widening. Delivery delays are increasing. Refineries are running at capacity. The smart money isn't buying paper gold anymore. They're taking physical delivery. They're storing it in secure vaults outside the banking system. They're treating gold like what it actually is, the ultimate form of wealth insurance. Now, if you're sitting on significant retirement savings, this is where things get really important. Most people have their entire retirement in traditional accounts, IRAs, 401ks. These accounts are typically invested in stocks and bonds, paper assets denominated in dollars. And while that's been fine during the long bull market we've experienced, it leaves you completely exposed to the exact risks that gold protects against. Here's something worth knowing. You can actually hold physical gold inside a retirement account. It's called a gold IRA. The IRS allows it. You can roll over existing retirement funds without tax penalties, and you can have actual physical gold stored in your name in a secure depository. I put together a detailed guide on exactly how this works. It's free. It's in the description below. If you have $100,000 or more in retirement accounts, it's worth understanding how this strategy works. Not saying it's right for everyone, but it's worth knowing your options when we're seeing the kind of market signals we're seeing right now. All right, back to what's happening in the market. Because the gold story is just one piece of a much larger puzzle, silver is doing something even more dramatic. Silver's been called the poor man's gold, but that's misleading. Silver is actually more volatile than gold. It's used in industrial applications that gold isn't. Solar panels, electronics, electric vehicles. The green energy transition that governments are mandating requires massive amounts of silver. And unlike gold, silver gets consumed. It's used up in manufacturing processes and never recovered. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. Right now it's trading much higher than that, which means silver is dramatically undervalued relative to gold. When gold makes major moves, silver typically follows with even larger percentage gains. We saw this in 2011. We saw it in 2020. And we're likely about to see it again. But here's what's really fascinating. The same geopolitical tensions driving gold are creating supply chain vulnerabilities for silver. Most silver comes as a byproduct of mining other metals like copper and zinc. When geopolitical conflicts disrupt mining operations or trade routes, silver supply gets constrained. And with industrial demand increasing and investment demand surging, we're setting up for a supply squeeze that could send silver prices to levels that seem impossible right now. Think about the broader context of what's happening in the world. We're not just dealing with one conflict or one economic problem. We're dealing with multiple simultaneous crises that are all interconnected. The war in Eastern Europe, rising tensions in the Middle East, the ongoing strategic competition between major powers, trade wars that are fragmenting global commerce, energy crises that are forcing countries to choose between economic growth and energy security. Every single one of these situations creates uncertainty, and uncertainty is gold's best friend. When investors can't predict what's going to happen next, when they can't trust that their government will protect their wealth, when they see the potential for their currency to lose value rapidly, they turn to gold. It's not speculation. It's survival instinct backed by thousands of years of human history. Here's a question worth considering. What happens when the current monetary system, built on unlimited debt creation and currency printing, finally reaches its mathematical limits? We're already seeing the early stages. Inflation that was supposed to be transitory became persistent. Interest rates that were supposed to stay low forever had to rise dramatically. Government debt that was supposed to be manageable is now consuming larger and larger portions of tax revenue just to service the interest payments. The math doesn't work anymore, and everyone in positions of power knows it. That's why they're scrambling to find solutions. Central bank digital currencies, negative interest rates, yield curve control. These aren't normal monetary policy tools. These are desperate measures deployed when the traditional system is breaking down, and every one of these measures makes gold more valuable because every one of them represents another step away from sound money and toward currency debasement. Let me paint you a picture of what this could look like in the coming months and years. Imagine you're holding significant wealth in a savings account earning 3% interest. Sounds safe, right? But if inflation is running at 6 or 7%, you're losing purchasing power every single day. Your account balance might be growing in nominal terms, but your ability to buy goods and services is shrinking. That's the hidden tax of inflation. And it's the exact scenario that gold protects against. Now imagine that same wealth allocated partially to physical gold. When inflation accelerates, gold prices rise to compensate. When currency values decline, gold maintains its purchasing power. When geopolitical crises erupt, gold provides stability while other assets crash. This isn't theory. This is exactly what's happened in every major crisis throughout modern history. Gold doesn't eliminate risk, but it provides a counterbalance to the specific risks that are most dangerous right now. The institutional investors understand this. That's why they're allocating. The central banks understand this. That's why they're accumulating. The question is, do individual investors understand this before it's too late? Because here's the thing about safe haven assets. They work best when you position yourself before you need them. Once the crisis is obvious to everyone, the price has already moved. The protection is already priced in. We're at that inflection point right now. Gold has moved significantly, yes, but relative to where it's likely headed if these geopolitical and monetary trends continue, we're still early. $3,000 an ounce sounds expensive if you're comparing it to where gold was 5 years ago. But if you're comparing it to where gold will be when the dollar loses its reserve status, when inflation spirals out of control, when the next financial crisis hits, $3,000 will look like an incredible bargain. Think about the velocity of change we're experiencing. The world is transforming faster than most people can process. The monetary system that's existed for decades is being challenged. The geopolitical order is shifting. Technology is disrupting everything. And through all of this chaos and uncertainty, gold remains the one constant, the one asset that's maintained value through every empire, every currency collapse, every financial crisis in human history. Here's what the smart money is doing right now. They're not trying to time the perfect entry point. They're not waiting for a pullback that might never come. They're systematically accumulating physical gold as a core holding in their portfolios. They're treating it not as a speculation, but as insurance. And they're sleeping better at night knowing that regardless of what happens in the markets, in the economy, or in the geopolitical landscape, they have a foundation of real wealth that can't be printed away or legislated out of existence. The war drums are beating, gold is responding, and the message is clear for anyone willing to listen. We're entering a period of unprecedented uncertainty and risk. The old rules don't apply anymore. The old assumptions about safety and stability are being challenged, and the investors who recognize this reality and position themselves accordingly will be the ones who preserve their wealth through whatever comes next. This isn't about fear. This isn't about panic. This is about clear-eyed assessment of risk and intelligent positioning. When you see central banks accumulating gold at record rates, when you see institutional money flooding into safe haven assets, When you see gold breaking through resistance levels like they don't exist, you're witnessing a massive repricing of risk. The question isn't whether you should pay attention. The question is whether you'll act on what you're seeing before the opportunity passes. The next few months are going to be critical. We're likely to see continued volatility in traditional markets, more geopolitical developments that shake investor confidence, more evidence that the monetary system is under stress, and through all of it, gold will continue doing what it's always done, preserving purchasing power, providing stability, offering protection when everything else is uncertain. Your move is simple. Educate yourself on how gold fits into a comprehensive wealth preservation strategy. Understand the difference between paper gold and physical gold. Learn about storage options and security. And most importantly, make a decision based on your own situation and risk tolerance. Because the one thing you can't do is ignore what's happening. The war drums are beating. Gold is responding. And the time to act is now, while you still have the luxury of choice.